Okay, welcome back. There's 30 minutes to go for the pre-open session. We have our first management ready. With us, PB Fintech is the company. Stocks come off from the highs, high-quality name. It's very strong revenue growth for a couple of years now. And this quarter is no different. So revenues were up 48%, but contribution margins were under a bit of pressure. We have Yashish Dahiya, Chairman and Group CEO at PB Fintech, with us now to sort of take some questions and run us through the outlook. Yashish, good morning. Great to have you with us here. It's always a pleasure. Prashant this side. Now, let's just start with premium growth if we can. So, it was running at 60% if you look at the first half of FY25. Actually, even in Q2, it was, north of 60%. It's come off a little bit to about 40-odd% now in the third quarter, October to December. Could you run us through what this was on account of and what kind of normalization should we see, from here on over the next 2 or 3 quarters?
Yeah, so see, growth stays our priority and will do so. This quarter on the savings side, we did not see the same growth that we saw on the previous quarters. So if you look at Q2, we had our savings business grew much faster than in Q3. So I think that had an impact, and of course, savings is a largish part. I think what continued to do very well was health. But even there, earlier we were growing at about 65, 67. Now it's more like 59. So clearly there is a little bit of, and of course our base is also increasing. See, long term, we say it's very good if we are able to grow at 30% on our core business. So anything north of 30%, I'm very happy with. 46 is quite an exceptional growth. Of course, I do agree that in Q2, it was higher at 60+%.
So, will we get to, Yashish, are we closer to this, getting to this normalized long-term 30% kind of growth rate? No.
See, no one can predict more than 2 quarters in terms of growth. Right now it seems like we are good. And we will be well ahead of, that particular average for maybe the next few quarters. But, long term, this is the hardest thing to predict in any business, at least in our business, like in consumer business. I can't predict exactly by the year how much the growth would be. And what we can predict very well is what our profits will be. That is very easy for us to predict because that largely comes from the renewal base, and the renewal base grows at a particular rate. But what is impossible to predict is whether the growth will be 20% or 30% or 40% or 50%. And that's why we say that we are very happy with a 30% number. I think we will do better than that for some time.
Okay, so FY26, I mean, again, I'm not asking you for specifics, just to kind of give a ballpark. Should be not sort of 40% plus kind of growth for 26?
No clue. Nobody can say. If I had any clue, I would have told you. It's not like I can tell you that our profits will double next year. But what I cannot tell you is whether we will grow or not. Yes, our effort will be to grow. See, we have things that we can control and things we can't control.
Sure.
Growth is very difficult to control because there are too many factors in it. Profit is very easy to control and predict.
Okay, so profits to double next year. Yashish, hi, Rima here. So health insurance has been a key driver for you. How much did health insurance contribute to your premium generated and revenues in Q3? What was the growth here? And what could the share be, to growth going forward in FY26? Is it possible to put a number to it?
See, the great news is health, which is the most critical thing that consumers require. So if you think about it, middle class people, if you ask them which is the most important product to them, that's health insurance. So growth there, and specifically when the industry has been at about 10, 12, 15%, growing at the rates we are growing, which is about 4 times faster than the rest of the industry, is very good. In terms of proportion, I think our health business would be almost a little more than 30% of our overall business in terms of premium. Of course, when you think of it from a net present value perspective, which means the lifetime value, it ends up being a little more than 60% of our business. And that's why I focus enormously on the health business, because I am the management, because it is the long-term driver of value for the company.
Got it. And I think that's very, very well put. So 60% of NPV, 30% of premiums, right? On the health side.
Broadly.
So that
broadly.
remains.
Yeah.
Your ESOP charge has come down to 51 crores in the third quarter, Yashish. Where do you see this moving, and how will this sort of play out at an operating level?
I think now onwards the ESOP charge will be largely stable. It'll be at about this number for a long time.
Okay. Your contribution margin in the third quarter has fallen about 400 basis points on a year-on-year basis. Could you talk to us about this?
Listen, whenever you grow, the way the rest of our businesses and our health business works slightly differently. And it's very important for anybody who's serious about our company to appreciate that. In most of our business, we make enough money in the first year to create a good contribution. In health, we do not. Health is a much more... So let me put it this way, right? If you wanted to take the net present value of health insurance, that would be almost equal to, let's say, X. And in the first year, you only make about 20% of that. So only 20% of your net present value comes through in the first year in health, while in every other business is between 70 to 90%. And what that means is while you take on a bulk of your cost, your acquisition cost, your marketing cost, your sales cost, your customer service cost upfront, most of your revenue is backdated. And so the way the health insurance business works is that you actually make a bit of a loss on the first year, and then you make profits for the rest of your life. And thus, from a net present value, it's the best business, but from a margin perspective, it's the worst business to grow. And this, it's pretty basic. So I think we are very happy about the fact that our margins gone down, because it's been driven by the faster growth of health business. And that's a phenomenal place to be in, because that just bodes so well for multiple years in the future.
Yashish, last quarter you mentioned that you will strategize a plan for Paisabazaar.
Yes.
So what will be the strategy for it, and what would your aspirations be?
I think Paisabazaar, we are getting quite clear about what we want to achieve there. So far, we work off the credit score program. It is going to be credit score and account aggregator. So you're going to see it evolve into some kind of a personal finance tool, which does not do just credit. So it's going to be unsecured credit, but also savings, investments, that is going to come into Paisabazaar. But more importantly, I think we are headed towards a strategy where there'll be much greater integration between Policybazaar and Paisabazaar. See, you think about it. Today I sell a two-wheeler, I make 50 rupees. I sell a credit card, I can make up to 2,000 rupees. Now, how difficult is it to attach a few credit cards onto your two-wheeler sales, one way or the other, right? And similarly, the other way around, loans on insurance policies, etc., and insurance policies for loans. So I think there's a lot of integration. That's why banks sell so much insurance, right? So I think you will see that integration come through very seriously. Just give us maybe a month or so to detail that out to you.
Although banks will now sell less insurance if these changes come through. But that's another conversation. But fantastically explained, Yashish, and the earlier point also on the health side and contribution. Just a quick word on the cash in the books, which is now about 5,500 crores. What do you plan to do with it? Are you looking at acquisition activity?
We don't have any concrete plans there. We don't have any concrete plans there. It's good for a business like ours, which is high growth and high impact on society, to be very safe and have a very healthy balance sheet. So we are happy with our position. We have no immediate intention of reducing our cash balance. I think cash balance will grow. I would say next year we should add about 700 crores or so to our cash balance. So we will, by the end of next year, we would have crossed 6,000 crores. And I think that's a good place to be. It just means that for the investors, this is increasingly a very stable company, which has a lot of cash flows and cash in it. But it's also at the same time a very young company. Think of it this way, right? Think of an 18-year-old making a lot of money. It's that way, because an 18-year-old is not supposed to be making money. They should be just investing. So we're a very young company, high growth, and at the same time, cash generative already.
A special dividend or something at some point?
I don't think that way. Yeah, we are let's say too young at this stage.
You want to hold on to the cash for no, absolutely.
I think we may have some uses coming up, and I don't want to be in a position when we've kind of just done dividends and sort of are looking around. And we don't time things, etc. So it's not like if there's some buyback or anything of that sort. I don't think that's how we operate.
Just one last sort of question. You own about 4%. The CFO owns about 1.5% stake. Would you stay at this level, or would you look?
I own about 5%, and Alok has about 1.68 on a fully diluted basis. Sometimes this, because of what you are seeing, you're not able to see all of it. But minus 5% and Alok is 1.68. I think we should stay at similar levels because we keep receiving ESOPs, and as we receive ESOPs, there will also be some dilution. Both me and Alok may also have to invest something in the health venture. So I think in many ways it should stay at about this level. I hope. I don't know.
And you're looking for investors in PB Health. At what stage is that at? You plan to hold about 25%, right?
We cannot be very specific. All I can say is I think PB Fintech is at this point struggling to get shares there. There's a lot of pressure on from other investors for PB Fintech to hold a little less than. So there's a lot of demand. There is a lot of demand. There's no doubt about that. I would say the demand is more than 2 times or 3 times the capital that we require. And so we're really selecting. We have selected the best investors. But see, I was authorized by the board to do these negotiations, I think on the 3rd of December. We are about 2 months into those negotiations. Just give me another 45 days or so, 30 days, 45 days, and I think we should have enough to announce. And at that time, what percentage PB Fintech has, what percentage other investors has should be quite clear.
And the overall value, I mean, what's the valuation? Would you be able to share that?
It's just a cash raise, right? So I think it's a bit flexible, but the capital raise should be between $150 to $200 million at the first level.
From outside investors. From outside investors.
Yeah, but overall, that's the capital raise for the thing, right? But there's a bit of flexibility there, right? So it could be less, it could be more.
Okay, got it.
And I'm sure it's not the only round. I think we will have a round 2.
You'll have more. Yes, absolutely.
Very soon after, and we'll have a round 3 very soon after. So I think this is the initial capital raise. I think at this point it seems like PB Fintech maybe less than 20%.
Maybe less than 20%. Got it.
At this point, it seems like that. So it's not even an associate company.
Okay. Got it. And we'll chat more when you are able to disclose more, as you said, maybe another 40, 45 days. And we'll do that. Thank you very much, Yashish, for joining us with all of that. Really a great conversation, and look forward to our next one. That's PB Fintech for you, 1650 or so, and the commentary coming in from the promoter, Yashish Dahiya.